Hello, and welcome again to another episode of Freedom Ain't Free. Today's video, we're going to be talking about the secret hole in your 401k and how to plug it. I was working with my clients and I was beginning to go through their overall strategies, and we started looking at what's going to happen on the back end. What's going to happen when we move to distribution, when we've accomplished what we set out to accomplish? You've done well, right? You followed my advice. You built that $2 million or more portfolio. Now you're ready to make that transition and start living off your assets instead of living off your labor. One of the pieces of the puzzle in your portfolio is in your tax deferred bucket. So we've taken the advantages of deferring our taxes for years and moving forward and passing those dollars to the future. But now the future has arrived. And we've got to figure out a strategy today to make sure that you can plug that hole so you won't be in this situation in the future. The government has a built-in trap, a built-in hole inside of your tax deferred strategies. That's going to be your 401k. That's going to be your IRA strategies, even some of your tax deferred annuity strategies, your pension, all of these pieces of the puzzle, even Social Security up to 85% will fall into this trap category. And that trap is taxes. One, we have no idea what tax rates are going to be in the future. We can all probably agree that they're going to be higher. So what is your plan, or what piece of the puzzle are you putting in place to plug this hole? Well, first we have to understand the full scope of the hole. So the government has attached to your tax deferred strategies a strategy of their own. That strategy is called an RMD, which is a required minimum distribution. It kicks in currently at age 73. What does that mean? The government says at age 73, you have to start withdrawing money from your tax deferred strategies. It's a requirement. If you don't, you have to pay up to a 50% penalty of what you should have taken out of those accounts and those strategies. So nobody's just going to give the government 50%. So you're going to make the withdrawal. Here's the challenge. When you start pulling that money out, you have to pay ordinary income taxes on the dollars that you pull out of your tax deferred strategies. Now, that's a part of the plan. Don't get me wrong. We want to build out your tax deferred bucket, but we also want to make sure that you have a fully diversified portfolio so you are not at the full brunt of the government's weight. How does a required minimum distribution work? I like to refer to it as the IRS automatic removal calculator, but basically the IRS has a calculator. This calculator says every year from age 73 on, you have to take out what is referred to as a dividable, right? You have to take out a certain amount of money every year. At age 73, you basically take your portfolio and you would divide that by 26.5 to start with. So as an example, if you had a $2.8 million portfolio, we divide that by 26.5, you have to withdraw $107,170 that year. All of that money is taxable. So on our current tax rates, you'll be looking at somewhere between 22 to 24% on the federal level alone, right? So that's over $20,000 a year you're going to owe in taxes, removing that $107,000. Now, if the market put up the gains that year and your gains were high enough to cover the withdrawal and the tax bill, you did great. You did fabulous. But you've got to make a strategy shift and a strategy change in order to be able to keep those gains high enough to cover both the withdrawal and the taxes that go on top of that. Also, your required minimum distribution grows every single solitary year so that the rate, the dividable, gets bigger every single solitary year. So we have to take into consideration what's going to happen with our money growing, as well as what's going to happen with the tax bill. Remember, you're shifting your work. That's what you're shifting from your labor to your assets. Your assets have to continue to work. Well, if your assets are working and they're working in a tax deferred category, then your assets are also creating a tax bill for you. That's the hole in your tax deferred strategy. And so we've got to put together a program that's going to help us combat that, a program that's going to help us work our way through those strategies so that way we're not beholden to the government and we're not losing or being forced to do things that we don't want to do. So when you're looking at the overall piece of the puzzle, you have your taxable strategies, your tax deferred strategies, and you got to begin to introduce tax-free strategies into your overall portfolio. If all you've been doing is putting money into your 401k, or all you've been doing is your 401k and your IRA, and you're a Henry, a high earner, not rich yet, you've got to begin to make a shift over into your tax-free strategies. So if you're overfunding those programs, and by overfunding, I mean if you're putting in more than your company's match into that tax deferred strategy, you will want to begin to reallocate those dollars into some tax-free strategies, so you have control over where you're pulling your money from, therefore reducing your overall tax liabilities. And or we want to create a strategy in the tax-free space to pay your bill, the tax bill that's coming off of your tax deferred portfolio. When I design strategies for my clients, the thought process behind it is each individual account is there to do a different thing. So I can design a tax-free strategy that's going to cover that $20,000 bill every year that I got to pay on my tax deferred strategy. Therefore, I'm only having to pull out of my tax deferred strategy whatever the required minimum distribution is. And or I have my tax deferred, my tax-free strategy big enough that I can keep extending that tax deferred bill for as many years as I possibly can in order to overall reduce my overall tax liability and plug the hole. We don't believe at ARC Financial Strategies in not paying taxes. We want to pay our fair share of taxes, but we only want to pay our fair share. And some of the strategies that we are able to put in place allow us to be able to get some of our money out of the tax system altogether. So here are a couple of ideas or a couple of strategies for you that you can use to build out your tax-free piece of your portfolio. And there are basically four things that you can do within that space. If your income is below the requirement or the maximum amount of income, we can use a Roth IRA strategy. Roth is simply the senator who got it approved. They wrote his name in the legislation. It's not an acronym. It doesn't stand for anything. It's just a tax-free version of either the 401k account or an IRA account. If your job offers the Roth 401k, use that option. If you make enough money, if you're under the cap, you can use the regular Roth IRA strategy. All of your gains there are going to be completely tax-free. You can also use one of four insurance strategies to create tax-free accumulation. So you can use a whole life strategy, an index universal life strategy, a universal life strategy, or a variable universal life strategy to get tax-free gains within your insurance portfolio. It basically boils down to how much risk you want to take, the difference between those insurance strategies. You can also look at the energy sector. Investing in our infrastructure, investing in energy, a portion of the gains that you will receive back from those dividends in the energy sector are completely tax-free. And then lastly, of course, we can invest in municipal bonds and treasury notes. We can invest back into our governments, local, state, or federal, and the gains that we will receive from those strategies will be tax-free at either the federal level or the state level, depending on which type of bonds that you buy. So when you're looking at your overall portfolio and your overall strategy, you want to begin to add in these tax-free pieces of the puzzle to put yourself in a position where you are in control. Required minimum distributions only apply to your tax-deferred strategies. So the bigger you build out your tax-free strategy, the more opportunities you have to be able to withdraw money and not have to worry about paying that large tax bill. Or we can build out your tax-free strategy and use the money in your tax-free strategy to cover the tax bill that's going to come from your tax-deferred strategy. And most of my Henry clients have the majority of their money in their 401ks and their IRAs. So we build out that strategy on the other side to take care of and cover the future tax bill. We also want to take into consideration the fact that taxes are going to go up. So as tax rates increase, RMD rates increase, and the amount that we have to pay is becoming higher every single solitary year. So we have to take that into consideration when we are making our shift from accumulation to distribution. When you put yourself in a position where you're ready to begin to start living off your assets, your strategy of growing your money begins to shift. You no longer are looking at pieces of the puzzle that's going to take or be very aggressive. We're going to be looking at moderately aggressive investments. We're going to be looking at some conservative investment aggressiveness, because the point at that point is income, not to keep growing your money. Although our money's got to keep growing. Your money's got to keep working. You can start working, but your money's got to continue to work. So we want to encourage you on today to go in and look at your portfolio and look at the individual pieces of the puzzle and put together some tax-free strategies. If you are not sure, if you're not 100% sure that you're going to have a great retirement, if you're not 100% sure that you've got the pieces of the puzzle lined up properly, and you want some more wisdom, knowledge, and information, here's what we want to do. We want to encourage you to join the Financial Freedom Institute. There's a link below in the description of this video. At the Financial Freedom Institute, you're going to get all the wisdom, knowledge, and understanding that you need in order to put together that $2 million portfolio, do the distribution the way you need to do the distribution, and build out those tax-free investment strategies to get you to where we want you to be, which is free. I want you to be able to pursue the things that you're passionate about. I want you to be able to spend time with your family. I want you to be able to enjoy your life in different cities, in different places all around the world. In order to do that, we got to get your money working for you so you can go and begin to live your life. Join us at the Financial Freedom Institute. Click on the link. All of the information is there and available to you. We look forward to seeing you on our next episode. And remember, freedom ain't free.